Joining us to talk about where the best opportunities are right now is Ben Emons from Medley Global Advisors. Ben, thanks for joining us today. I mean, talk about whiplash, roller coaster week here for the major averages. Dead cat bounce, or is this rally for real?
Hi, Morgan. Well, it's definitely a good rebound, but I have to say, though, we have to be very cautious here because this conflict in Ukraine is far from over and may even widen. You know, there's a lot of back and forth now where they hold those talks about the Ukrainian government and the, well, maybe independence of Ukraine or not. So that's very uncertain. At the same time, we're seeing what we call the tit-for-tat sanctions coming through now, right? We started with yesterday the U.S. and Europe to Russia. Now Russia is planning to do counter-sanctions. So it's a good rebound. It shows a lot of defense in there, meaning healthcare staples were really the outperformers today. So I'm not sure if it has more legs from here, given the uncertainty of the situation.
So do you see opportunities right now in this market, and if so, where?
Well, in any crisis, there's opportunity, Morgan. It's interesting how the materials, as well as they think of cyber stocks or defense stocks, that you were talking about earlier on another segment, or even thinking about, zinc and nickel, companies that are really involved in those sectors, they can actually outperform because, if anything, if this conflict does ease, the global economy will continue to reopen. Those sectors will continue to benefit. But if the conflict widens, it gets worse, there will be more demand even too for those raw materials and zinc and copper. So I think that's the sectors you want to focus on and be more overweight as say, an offensive play in this uncertainty.
Ben, has anything that we've learned the last several days with Russia's invasion of Ukraine changed your expectations for what the Fed may or may not do on March 15th? Does it add one more data point to what they had already pretty much decided they would do with rates, or does it change any of the thinking?
Yeah, we at Medley still think that this will be not a distraction from the planned tightening cycle that's really conveyed now through all the messaging. If you take Baller today, and he's been most in the forefront, he still makes the same message. It's going to be 100 basis points. You have Baller who reiterates that keep the 50 basis points as an option on the table. So to our thinking, this is a front-loaded tightening cycle that the Fed has to execute upon. If anything, the geopolitics that we're dealing with is inflationary. It probably will be another wave of inflation, to call it that way, coming at us, given that yesterday we had a significant shock in energy. So I think the Fed will lift rates in March and follow with other steps in May and June, and then reevaluate what they're going to do with the balance sheet. That may be the only thing that could at some point become uncertain if the conflict in Ukraine becomes even bigger. At this point, though, the Fed is, I think, poised to just simply lift off and continue to raise rates.
So what's the implication for credit markets, which I know you're watching closely right now as well?
It's carefully to watch, Morgan, because credit is an important aspect of the economy now. We've had a really good recovery of the economy, and when you ever get commodity shocks, you get some stresses in the system, and that showed yesterday. Now, for example, if you take all the energy companies were actually not performing as well as financials, it told me there's stress there. And then if you look at the returns of credit this year, they're negative, not only negative, but they're more negative than equity returns, and that's a combination of rising rates, but also an expectation the economy will slow down over time as inflation becomes more pressing and the Fed has to tighten. So I think credit spreads could widen from here, and as a result, it will be ultimately a situation where it prices in a more major slowdown of the economy.